New home sales for June are just out from the Toronto Regional Real Estate Board.
If the cost of renting or buying a property is making your head spin, there is a third option you might not have considered.
In Canada's housing market, condos are the weakest link. The steepest drop in sales and prices have been in Toronto. The trends in Vancouver are troubling too.
You're browsing real estate listings in Ontario, dreaming of finding your perfect home. But beware, some markets are crashing faster than you can say sold. The numbers are stark, and the trend is unmistakable. Are you about to invest in a money pit? Do you know which Ontario real estate markets are crashing fast? The warning signs are clear. Prices are dropping, sales are slowing, and savvy buyers are bailing. Let's take a closer look at the 10 Ontario real estate markets that are tanking and what you need to know to avoid getting burned. Number 10. Toronto. Toronto, often the crown jewel of Ontario's real estate market, is facing an undeniable slowdown. The benchmark home price in the Greater Toronto Area, GTA, fell to $995,100 in June 2025, which was a 5.5% year-over-year drop and the lowest it has been in 4 years. For context, this is the first time since 2021 that the benchmark price has slid below the crucial $1 million mark. This decline is even steeper for detached homes, where prices have plummeted 6% compared to last year, averaging $1.39 million. Condos are not faring any better, with their average price shrinking to $696,000, marking a 4.3% yearly dip. These stats are enough to make any investor pause. A big driver here is the inventory. Active listings in Toronto surged to 31,603 by the end of June, a jaw-dropping 34% increase year over year. This represents the highest inventory level Toronto has seen in over 3 decades. More listings usually mean more choices for buyers, but this abundance of options signals one thing loud and clear: people aren't buying as fast as they used to. This, coupled with stubbornly high borrowing costs due to previous interest rate hikes, is keeping buyers on the sidelines. Even with recent rate cuts by the Bank of Canada, many potential buyers are cautious, waiting for further clarity on the economy or hoping prices will drop even more. It's not just about numbers. Buyer behavior is shifting too. The city has shifted firmly into a buyer's market, currently stuck at a sales to new listings ratio, SNLR, of 32%, where anything below 40% tilts the favor to buyers. Properties are taking longer to sell, hovering on the market for an average of 42 days, compared to just 30 days this time last year. The days of buyers scrambling to outbid each other are long gone for now because Toronto is all about negotiation today. Number 9. Hamilton. Hamilton's market, once buzzing with activity and rising prices, has found itself in a decidedly different phase. The numbers paint a clear picture. By June 2025, the average home price in Hamilton dropped to $832,212, a modest 1.42% decrease compared to last year, but with notable variations across property types. Detached homes at $930,007 saw only a slight decline of just over 1%, but semi-detached homes plummeted 13.38% to $658,949, and condos sank by a whopping 13.88% on average. But what's really rocking Hamilton is the surge in listings. New listings increased a remarkable 12.3% compared to last year, with 2,363 active listings, representing a year-over-year jump of over 30%. Unlike the days when inventory vanished almost as soon as it hit the market, homes are now sticking around for an average of 33 days, a 26% reduction in speed compared to 2024. This inventory spike is fundamentally changing the dynamic, leaving sellers scrambling to price aggressively to attract increasingly discerning buyers. Speaking of buyers, they're playing it smart. After years of feeling rushed, buyers in Hamilton are finally taking their time. They're leveraging an increase in choices, especially as semi-detached homes and condos dip into more affordable territories. Economic instability and shifts in employment patterns are adding to buyer hesitancy, leaving the market primed for negotiation. If you're selling in Hamilton, pricing it right is no longer just helpful, it's mandatory. Number 8. Mississauga. Mississauga's real estate story for 2025 parallels its GTA neighbor, Toronto, in many ways. But it also has its own set of problems. Like other markets, prices here aren't holding steady. The average home price across the city stands precariously at $1,050,000, a marked decline from its 2024 levels. Condos, once a rising star in the affordability game, now average $622,000, showing noticeable signs of wear as demand shifts elsewhere, or stalls entirely. Inventory upticks are also playing a big role in Mississauga's downturn. The city saw a 15% surge in new listings compared to last year, creating plenty of opportunities for buyers to hesitate or hold out for better deals. This swelling supply isn't meeting equally robust demand, however. Buyer activity has dwindled as mortgage rates remain a chief concern for most first-time buyers and seasoned investors alike. A staggering 38% of listings in Mississauga currently remain unsold beyond the 30-day mark, compared to just 25% last year, a stark warning to sellers banking on quick sales. Borrowing costs aren't the only challenge here. Demographics are shifting too, as fewer families entering Mississauga opt to buy homes outright. High immigration rates, one of the region's traditional demand drivers, haven't fully translated into purchase activity thanks to pricier borrowing and a shift toward rents. Pair that with macroeconomic uncertainty and a sometimes unpredictable labor market, and Mississauga's lost steam becomes easier to understand. Number 7. Oshawa. Oshawa, often marketed as an affordable alternative to Toronto, is facing a remarkable cooling-off period. Home prices have taken a hit, with the average price for a property dropping 6.1% year-over-year, leaving properties priced at $769,938 as of February 2025. This is already nearly $50,000 lower than 2024 figures. Apartment-style condos have been hit the hardest, with a jaw-dropping decline of 18.2% in value compared to last year. They now hover around $373,200. A substantial loss for investors who purchased at higher prices just a couple of years ago. Even detached homes, which typically fare better in rough markets, saw an annual drop of 5.6%. Inventory is another piece of Oshawa's troubling real estate puzzle. Active listings have skyrocketed by 109.6% from February 2024, reaching 438 properties on the market at the start of the year. This inventory overload is giving buyers the upper hand as there are simply too many choices and too little urgency to make offers. Sales numbers tell a similar story of hesitation, with transactions plummeting by 21.2% year-over-year. Properties are lingering for an average of 24 days on the market, a notable slowdown from Oshawa's heyday of fast-tracked sales. Economic uncertainty isn't helping either. With mortgage rates still at comparatively high levels and inflation putting pressure on household budgets, many would-be buyers in Oshawa simply can't afford to take the plunge. The city's reputation as an affordable neighbor to Toronto is also waning, as developers have oversaturated the market with condos and townhomes aimed at first-time buyers, many of whom are now priced out. Add to this a population that's not growing quickly enough to absorb the consistent rise in listings, and you've got the recipe for a precarious housing situation. Number 6. Niagara. The Niagara region, celebrated for its scenic beauty and appeal to retirees, is undergoing a real estate shakeup that's catching many off guard. While the overall average sale price in the region has only dropped a modest 0.7% year-over-year, from $700,098 to $695,384, the underlying trends signal deeper issues. First-time buyer properties in the $500,000 range are seeing significantly less interest as household budgets tighten. Even newly constructed homes with the prized escarpment views, once a go-to for move-up buyers willing to stretch their finances, are struggling to move in the $800,000 to $1 million market band. What's worsening Niagara's market imbalance is the sheer flood of new listings. By the end of 2024, the region saw a 28.6% increase in listings, with a staggering 28,031 properties hitting the market that year, compared to just over 21,000 in 2023. This massive inventory hasn't met equal demand. Despite a 4.2% rise in sales during the same period, the excess is imbalanced. That's more supply than the local population or even out-of-town buyers can currently absorb, particularly when confidence about affordability has taken a nosedive. Niagara's real estate seems to be bearing the brunt of unique economic challenges. Retirees looking to downsize are competing with first-time buyers for reasonably priced properties in cities like St. Catharines and Niagara Falls, but with mortgage approvals requiring larger down payments due to pared-back amortization structures, many can't proceed. Adding to the difficulty is the lack of substantial new construction. Rising costs in materials and land have significantly slowed projects, putting additional strain on an already tilted market dynamic. Number 5. London. London, with its historical charm and draw as an educational and healthcare hub, has seen better days when it comes to real estate. Home prices across London have largely stagnated or softened. Detached homes, for example, are no longer commanding the premium they once did. The demand in the city's condo space is also lacking, with older units no longer being seen as viable investments, and new construction projects being priced far above what the average buyer can afford. At the heart of London's trouble is inventory. Active listings are at a 3-year high. Developers continue pushing out projects, but the absorption rates are telling a difficult story. There's simply not enough demand to balance this incoming supply. Coupled with rising costs of living and stricter qualification criteria for mortgages, fewer households are prepared to make significant real estate moves right now. Economic uncertainty stemming from shifting migration policies and ongoing trade tensions is another complicating factor for London. The city historically benefits from a healthy influx of new immigrants, bolstering demand for housing. But recent changes in Canada's immigration strategy are casting a shadow over this pattern. Similarly, ongoing tariffs and supply chain interruptions are making it incredibly expensive to maintain or expand properties, further dampening homebuyer enthusiasm. Number 4. Oakville. Oakville, long regarded as a status symbol in the GTA thanks to its million-dollar homes and upscale appeal, is losing momentum. The average house price in Oakville as of May 2025 stands at $1.49 million, but this represents stagnation after years of robust growth. Prices have barely budged year over year, and the demand for high-value detached homes has softened significantly. The deep pool of wealthy buyers that typically fuels Oakville's market is shrinking, as rising interest rates have forced cash-sensitive buyers to rethink their purchasing power. Detached homes, which once commanded a premium, are not flying off the shelves like they used to, which has left sellers adjusting their expectations downward. Inventory levels in Oakville reveal an even bigger issue. With 887 new listings in the past month alone, the market now feels saturated. Properties are languishing on the market, with the median number of days it takes for a home to sell inching upwards to 28 days, compared to the much faster turnaround seen in previous years. Sellers are becoming increasingly anxious, and price reductions have become a common strategy to attract offers. This glut of available homes is nudging Oakville closer to a buyer's market, as supply far outweighs demand in key price brackets. For buyers, Oakville's cooling market presents opportunities, albeit cautiously. While prices haven't seen steep drops, the leverage is clearly swinging in their favor. High-end homes, such as the newer 2-story detached builds, are being negotiated down from their lofty asking prices. On the flip side, potential buyers are not rushing in, indicating hesitancy, likely driven by fears of future rate hikes or further price corrections. The Canadian Real Estate Association, CREA's forecast of a 0.9% dip in overall home values across the GTA in 2025 further validates this wariness among buyers. Economic uncertainties are compounding Oakville's challenges. Ongoing trade disputes and less predictable investment flows into the region have recessed buyer confidence. The high price point of homes in Oakville doesn't provide much insulation against broader market downturns, making it one of the GTA's struggling luxury markets. Number 3. Brampton. Once heralded as an affordable alternative to Toronto, Brampton is now grappling with a real estate slowdown that threatens to reshape its market identity. The average home price in Brampton as of June 2025 is $954,523, representing a 5.5% drop year over year. Detached homes, a market staple, have seen their prices drop by 7.1%, falling to $1.09 million, signaling weaker demand for larger properties. Semi-detached houses, townhouses, and apartments haven't fared much better, with declines of up to 14.6% for condos. This points to affordability pressures that aren't sparing even the previously budget-friendly segments. Brampton's inventory levels paint an even starker picture. Active listings are climbing steadily, and average sales volumes have shrunk. 476 transactions were logged this June, translating into a 2.7% decline compared to last year. With more homes competing for fewer buyers, Brampton's once tightly contested market is now easing into a buyer's market. Sellers are feeling the pinch of lengthy listings, with condos and townhouses facing the most resistance. Many homes are now sitting unsold long enough to force price reductions, eroding property values further. Buyer apprehension in Brampton is starkly noticeable. Dissuaded by tightened mortgage qualification rules and steeper carrying costs, families that would have formed the core of the buyer pool are holding back. Meanwhile, those who do venture in are driving hard bargains, knowing full well that there's no shortage of choice. Add in volatile mortgage rates and stagnating wage growth, and it's clear why Brampton buyers are treading carefully rather than rushing into purchases. Economic instability stemming from broader factors like ongoing inflation woes and job market concerns has worsened the situation. Brampton, being heavily reliant on its commuter-friendly appeal for homebuyers, is caught in Toronto's economic shadow. Until confidence returns at a regional or national level, Brampton's housing woes are unlikely to dissipate. Number 2. Windsor. Windsor, Ontario's southwest gateway to the United States, has also found itself knee-deep in a turbulent housing market. Average home prices have plateaued, with properties selling for around $579,910, a figure that hasn't moved much in the past year. Despite stable pricing, sales activity highlights the cooling demand. April 2025 saw just 416 homes sold, a steep 15% decline from April 2024. The lingering uncertainty from US-Canada trade relations, especially tariffs impacting the auto sector, is fueling economic anxiety that directly affects Windsor's housing market. The supply-demand equation is tipping uncomfortably for Windsor sellers. Listings have jumped by 9.5% year over year, leaving the market awash in homes without a corresponding uptick in buyers. A 21% month-over-month increase in sales from March to April does hint at slight recovery, but it's far from the bustling activity seen in Windsor's peak years. With inventory levels swelling, realtors are preparing sellers for longer durations on the market than anyone would like. However, the situation is not entirely dire for Windsor. Bidding wars in specific price tiers, particularly those under $700,000, reveal that well-priced, move-in-ready properties still find eager buyers. That said, confidence doesn't extend far beyond these segments. Many buyers are adopting a wait-and-see approach, wary of overpaying amid ongoing volatility in mortgage rates and job security concerns in Windsor's industrial sectors. Even high-income buyers are noticeably more cautious, reflecting how economic unease cuts across demographic lines. Windsor's fate is also tied to its unique position as a border city. Economic dependencies on U.S. trade, particularly for industries like automotive manufacturing, mean that uncertainties around tariffs, factory closures, and layoffs spill over into the housing market. Until these macroeconomic tensions ease, Windsor's real estate players will find it difficult to instill confidence. Number 1. Kitchener-Waterloo. Kitchener-Waterloo, once the crown jewel of Ontario's burgeoning tech corridor, is feeling the weight of real estate pressures. Detached homes are no longer the surefire investments they once were. Average prices in this segment are softening alongside an overall dip in housing demand. Townhomes and condos, while traditionally appealing to young families and first-time buyers, are also seeing slower sales amid a shift in buyer priorities that heavily prioritize affordability over location or amenities. Rising inventories further underline the challenges. New home construction has not slowed despite cooling demand, and this oversupply is driving market imbalance. Homes are lingering unsold for weeks longer than the region's recent history would suggest, and developers with unsold units are sweetening deals with buyer perks, from waived fees to extended payment terms, to move their stock. Kitchener-Waterloo's buyer base is shrinking, and that is not for lack of interest, but because affordability is becoming a blockade. With higher down payment requirements and stricter lending standards, the entry-level buyer is effectively shut out. Even for those with the means to buy, hesitancy prevails, as fears of over-leveraging amid a higher interest rate environment are holding many back. This dent in demand isn't just a financial issue, but also reflects second thoughts about investing during potential home price declines. The high cost of housing and a mounting oversupply are compounded by economic questions about the region's ability to maintain its momentum. Once driven by the rapid expansion of tech firms and associated job growth, Kitchener-Waterloo's market now faces stagnation in hiring. Paired with a general slowing of real estate activity across Ontario, the area's growth narrative feels less convincing. If you enjoyed this video, let us know in the comments section down below, and turn on your notifications to know when next we upload. See you in our next video. Bye-bye.